Welcome, dear traders. This is the latest review of the US stock market by InstaForex, and the US market is in a turmoil at the beginning of the new week. Recent high-profile collapses in the US banking sector have sparked fears of the market crash. The US government has quickly stepped in with a bailout, but fears of a contagion remain. Reports on the bankruptcy of the Silicon Valley Bank have sent US stock indexes down by more than 1%, overshadowing positive labor market data. As a result, investors abandoned US assets, anxious that the SVB's collapse could signal that the US banking sector is in trouble. The Dow Jones Industrial Average lost 345 points, or 1.07% by the closing bell, while the NASDAQ slumped by 1.76%. The S&P 500 slid down by 1.45% to 3,861 points. Key US indexes extended their losses on Monday, losing between 0.6% and 1.1% after unsuccessfully trying to recoup their losses. As a result, the S&P is forecast to trade in the intraday corridor between 3,740 and 3,910 points. The S&P tumbled by 4.6% last week in its worst weekly performance since September 2022. The Dow Jones slid down by 4.4% last week, losing more than 3% since the beginning of the year. On the other hand, the NASDAQ dropped by 4.7% in the last 5 trading days, but advanced by more than 6% since the beginning of 2023. The sell-off was triggered by the situation in the US banking sector. On Wednesday, the Silicon Valley Bank, also known as the SVB, had an emergency stock sale but failed to raise the funds necessary to meet its obligations. At the same time, crypto lender Silvergate announced that it was shutting down due to catastrophic losses it had sustained in the collapse of a FTX drama. The news forced investors to reconsider cracks in the financial system, as well as brought up potential threats to both the sector and the economy as a whole. The regional banking index lost 2.4% during the trading session, while the S&P financial index closed to be the loss of 1.8%. The problems facing the US banking sector have reminded investors of the stock market crash of 2008, completely overshadowing the positive labor market data. The non-farm payrolls report showed that the US economy added more jobs than expected in February. Average hourly earnings slowed down, while unemployment accelerated to 3.6%. The data elevated some fears that the Fed might raise interest rates by 50 basis points at its meeting in March. The worst performing stocks were Silvergate, which plummeted by 22.9%, and the local bank First Republic, which dived by 14.8%. Shares of clothing retailer Gap lost 6% after the company reported a greater than expected fourth quarter loss. Its sales also was shot. The market entered the new week with a touch of relief, but were overtaken by depression. The sudden shutdown of SVB on a Friday after a failed attempt to raise funds raised concerns about risks for other banks. The New York-based Signature Bank was also shut down over the weekend. SVB and Signature Bank are now the second and third largest bank failures in the US history. As a result, bank stocks around the world have been hit hard. Questions are mounting about the impact of the Federal Reserve's steepest cycle of rate hikes since the early 1980s. Over the weekend, regulators stepped in to restore investor confidence in the banking system, saying SVB depositors would be able to access their funds on a Monday. The Treasury Department and the Federal Reserve announced that they would insure all depositors in the SVB, even if their cash holdings are above the $250,000. However, stock and bond holders would not be bailed out. Similar arrangements were made for depositors at New York Signature Bank. Officials have stressed, however, that the bailout is intended to protect customers, not companies. In response, the US government has unveiled the Bank Term Funding Program, which will provide emergency funding to insured banks in exchange for collateral such as the US Treasury bonds and agency debt. The SVB's bankruptcy also impacted the UK. The British subsidiary of the bankrupt bank was acquired by HSBC for £1 amid anxiety among tech sector customers. The takeover pushed shares of HSBC down by 2.6% in the London Stock Exchange. Despite all efforts by regulators, public confidence in the US banking sector has been undermined once again, sending back stocks downward. Shares of a First Republic Bank were hit particularly hard, plummeting by 61.4% in pre-market trading. Major US banks such as JP Morgan, Morgan Stanley, and the Bank of America lost between 1% and 5%. Mega-cap stocks such as Apple, Tesla, Amazon, Microsoft, and Meta were largely in the negative territory. Some managed to edge up by 0.1%, but overall, mega-caps suffered losses up to minus 2.8%. All stock also declined, dropping between 2.3% and 5.7%. Meanwhile, growing concern over the future of the banking sector has led traders to raises the expectations of the Fed's rate hikes. Now the regulator is expected to revise its rapid tightening policy. From that standpoint, the US CPI report for February, which will be released on Tuesday, will be vital for evaluating the Fed's future actions amid the current banking crisis. In the meantime, high market volatility persists. Nervousness could lead to both a significant downturn and rebound fueled by hopes of rate hikes being paused. The forex market also experiences raging volatility. On a Monday, the US dollar index was hovering above the level of 104 points, dropping by 0.2%. The fall had accelerated right before the trading session started. The index lost 0.7% and traded near 103.80. As for the forecast, the US dollar index is likely to move within the trading range of 103.30 and 104.20. Considering the stress put on the US banking system, investors wondered if the Fed would raise interest rates by 50 basis points next week. Meanwhile, Goldman Sachs stated that the US regulator is likely to refrain from rate hikes. At the same time, the bank still projects rate increases in May, June, and July. Currently, the market estimates a 33% chance that the Fed will maintain the current rate and a 67% chance of a 25 basis point hike. The US dollar weakened amid a dramatic change in interest rate expectations. The 2-year US Treasury bond yield, which usually changes in line with the interest rate expectations, declined by 23 basis points. Since Thursday, it has sagged by straggling 66 basis points. This has been the biggest drop in the 3 sessions since the Black Monday crash of 1987. This created a roadblock for the US currency. Meanwhile, the euro, pound sterling, yen, Australian dollar, and other G10 currencies rose from 0.6 to 1.7% against the US counterpart. The reassessment of the future monetary policy expectations helped the Australian dollar to rebound from a 4-month lows and regain ground against the US dollar. The USD card pair began the trading week with a decline of 0.3% to 1.3790. As for the forecasted range, the pair may remain in the range of 1.3720 and 1.3820. The Australian currency strengthened against the news that the Fed may be taking a more aggressive tightening of the key rate of the table. At the same time, the strength of the surge is restrained by a significant drop in oil prices. Brent crude oil futures posted a steep decline of 4.8% to $78 for barrel against the news about the banking crash. Market sentiment was already unsustainable. Perspectives of the Fed's monetary policy tightening were overestimated, which was exacerbated by large reserves of crude oil in the United States. Recently, the weaker US dollar, as well as the optimism regarding the reopening of the Chinese economy and the growth of demand for jet fuel, provided some support to prices. Today, fears of another financial crisis prevailed over the optimistic forecast, and the market became totally pessimistic. Oil has lost about 5%, which has not been observed since December 2022. In addition, volatility in the market persists. Investors are looking for ways to mitigate losses by moving their money into safe haven assets, and the commodities market is one of them. The cryptocurrency market survived the banking stress test. The panic led to a rise in traditional digital assets. Bitcoin managed to strengthen to $22,100. Ethereum also recovered to a solid price of $1,580. Meanwhile, other top altcoins traded between the ups and downs, with some of them losing and gaining up to 5.6% and 3.4% respectively. The US authorities' auctions helped the USDC stabilize to 0.9917 from the all-time low of 0.87. At the same time, the asset still stands below the benchmark 1-to-1 pegged to the US dollar. On Sunday, CEO of a Circle, Jeremy Allaire, AUSD issuer, tweeted that the company's $3.3 billion reserve deposit to help a bankrupt would be fully available when the US banks open on Monday. During the US pre-market trading, crypto miners White Blockchain and the Marathon Digital, cryptocurrency exchange Coinbase, and software developer MicroStrategy also bounced from last week's lows and gained 6.5% and 10%. At the same time, the market sentiment remains strained with the collapse of SVB and California Silvergate. The shutdown of the latter means that the three major US banks used by cryptocurrency businesses have collapsed this year. Leading US exchange Coinbase said it had about $240 million of corporate money in a signature as of Friday's close. The exchange intends to fully return to the funds. It may be hard to assess now, but the unfolding drama proves that Bitcoin can be used as a safe haven asset. Probably that's why the BTC price did not plummet on the news about the bankruptcy of a Silicon Valley bank. Compared to USDC, Bitcoin looks more promising. The digital asset may have a bright future, considering the overestimated rate hike prospects. At the same time, taking into account the stress and turmoil reigning in the markets, volatility may be excessive in the coming days. Considering this factor, the asset is likely to fluctuate within a wide range between of $20,200 and $24,500. Trade prudently with the InstaForex and see you online tomorrow.